Hello everyone, and welcome to session 2 of our virtual Marine Money Ship Finance Week, coming to you live from our offices in Singapore and New York. Although we would have loved to be with you in person, in times like these we have no other choice but to resume our networking and intelligence sharing online. Before we jump into the session, I would like to thank all of our partner and corporate sponsors and supporters of our virtual Marine Money Ship Finance Week. I am your host, Andrew Oates, and today I'm very happy to introduce our first presenter, David Jordan, who is Regional Director Asia at MSI. And David will deliver a presentation with the title, Shipping in the New Normal, Understanding Market Drivers at a Time of Heightened Uncertainty. David, over to you.
Thanks very much, Andrew. As Andrew said, my name is David Jordan, and I'm the Regional Director for MSI here in Singapore. Next slide. Next one as well. So, thanks. For those of you who aren't familiar with MSI, we're a leading independent commercial maritime forecasting and management consulting firm with offices in London, headquartered in London, and as offices here in Singapore. In terms of our product offering, we offer high-level independent market forecasting and business advisory services for all of the shipping markets, all of the offshore markets and allied industries, so ports, shipbuilding. Now, given time constraints, next slide, today's market review is going to focus on the three main shipping sectors. And I'll follow that with a brief review of the shipbuilding industry. Now, the review that I'm going to give will be largely based on MSI's most recent base case scenario, our Q3 2020 base case scenario, which was released a couple of weeks ago. But given the pervasive nature of uncertainty in the post-COVID-19 world, what I'd like to do is I'd like to round off by presenting some scenario-based analysis and looking at some potential low and high case forecasts for the various markets. Now, let's start with bulkers. Now, earnings in this market have recovered in July from the lows that we registered earlier on in the year, and since July have largely stabilized. Now, when you look at this market, analysis of trade and fleet growth fundamentals only really partly explains the recent freight market surge, and there have been key additional drivers, largely a combination of logistical difficulties related to COVID-19, which have created bottlenecks and fleet inefficiencies. I'll come back to that a bit later, but just to run through the basics, let's have a quick look at demand and each of the bulks. So first, iron ore. Now, Chinese iron ore imports have actually been one of the few sources underpinning the positive demand story this year. China had a very rapid rebound from the COVID-19 pandemic, which is ongoing. In fact, it's gathering pace. Their industrial outputs, fixed asset investment have brought back into life. As a result, steel production has expanded. And what we've seen in the first half of the year is this has provided very supportive of imports into China, and we've seen a 7% year-on-year increase. Now, generally, you know, I don't think it's controversial to say that, you know, I mean, looking forward through to the end of the year, we do actually think iron ore trade in the second half will be stronger than the first half, but obviously there are those downside risks. On the flip side of the coin, the seaborne trade in coal has been very poor this year. COVID-19 has taken a very, very heavy impact on electricity demand, and this has disproportionately affected the consumption of coal, particularly as the graph shows in Western Europe and India. In terms of risks, another real and present danger in the short term is the potential for an end-of-year collapse in Chinese imports, similar to the ones that we saw in 2018 and 2019. Now, if you bring all of these together, all of these factors together, in terms of our base case forecast, seaborne coal trade is going to decline this year. We're probably looking at around about a 7, although close to 8% decline year on year. Turning to grains, food security is obviously a very important issue for everybody facing the pandemic, and a lot of support has been given to this trade. Now, there have been better harvests in the US this year. And there has actually been great demand in China off the back of problems that they've had with their domestic harvests. And this has all been very supportive of trade. Now, looking at 2020 as a whole, we're expecting soybean trade to grow around about 1 to 1.5% year on year. in 2020, and wheat and coarse grains to grow more significantly at around about 3%. Now, moving on to minor bulks, our forecast for 2020 here isn't as optimistic. Now, there are pockets of strength, and these have largely been driven by Chinese demand. So here we're talking about cement and petcoke, bauxite. But overall, when you look at sort of the minor bulks as a whole, we are expecting a fall in trade this year. So if you pull all of these strands together, and on the next slide, we just show you in terms of what we expect annual incremental demand this year and into the next 2 years are going to be. So basically, the increases we're expecting in iron ore and grain trades this year isn't going to be enough to offset the declines in coal and minor bulk trades. And we do expect seaborne trade to fall by about 1% this year. But we are expecting a strong rebound next year into 2021, 5%, and that will actually take us to levels in excess of those that we saw in 2019. Now, alongside the relatively modest, it's a fall, but it's modest, and fall in trade this year, we are actually expecting rather robust supply growth of around about 4% this year. Deliveries into the market have continued apace. Scrapping levels have been very, very sluggish given what's going on at the ISC. But beyond 2020, into 2021, 2022, we expect to be very, very different. The order book is very, very heavily front-loaded. Contracting has been limited. This is going to translate into quite a substantial fall in deliveries next year and into 2022. Conversely, as the pandemic unwinds, we do expect to, and breakers reopen, we do expect to see scrapping increase. So we actually believe that the bulk carrier fleet will peak. The available fleet will actually peak in size in 2021 and then contract marginally for a couple of years after that. Now, it's interesting to see how this translates into fleet employment rates and earnings. Now, if you look purely at fundamentals on the next slide, the weak demand growth and strong supply growth that we're expecting this year and that we've seen translates into very low employment rates. Logically, that would translate into low, time charter rates. However, as I previously said at the beginning of this section, we've seen a lot of exogenous factors have a positive effect on earnings. So here we're talking about congestion. I mean, I know crew changes a lot of difficulties around there, but it has proved positive in terms of helping to buoy rates. Now, into next quarter, into Q4, we do expect rates to fall, but because of these exogenous factors, we won't see declines to levels that we saw in 2016. Moving out further ahead, this contraction in the bulk carrier fleet that I mentioned, and this sort of steady increase in demand growth, so this spike next year and then steady increase afterwards, will support a slow rise in fleet employment. Despite this, we are expecting fleet employment to be around or below 83% over the next couple of years. Interestingly, that's the lowest level since 1980, but that's obviously a period when time charter earnings barely covered operating costs. But, and this is very crucial, and the structure of the market is very different now than the 1980s. And again, support from these exogenous volatile factors, key drivers, they will provide short-lived support for spot freight rates, and that will maintain upwards pressure on longer-term time charter rates. Now, moving on to the container shipping market, continuing a relatively positive tone, the container ship markets have really upended expectations this year, and recent months have seen some of the most surprising developments yet. I mean, if you take container trade by way of example, now the graph on the right of this slide compares our base case outlook for year-on-year vessel demand growth in 2020 from June with our most recent forecast, as I said, that were published a couple of weeks ago. Now, we're still very much in negative territory, but the positivity or the relative positivity that's infused the markets over the last couple of months means that our outlook for 2020, we've revised it, and yes, there are still decreases, but the decreases that we expect are much smaller than previously. This sort of sense of positivity is particularly true on the main lane trades, specifically Trans-Pacific head haul. Intra-Asia trade has also shown some resilience, or more resilience than anticipated, particularly on the sub-trades exposed to China. On the other hand, developments on non-main lane trades have generally remained weak, particularly on the non-main lane east-west. Now, on the next slide, the upshot for all this is we now expect global primary container trade will shrink by around about 5% in 2020. Now, in historical context, this is a difficult outcome for an industry that's used to growth, and indeed we've only seen contraction in trade once before in the GFC. But again, to stress, it's less severe than many initially expected. Plus, we do expect all of this lost ground to be made up in 2021, 8% trade growth in 2021, which, as with bulkers, will take it above the 2019 levels. Turning to fleet developments, we are in a period of slow growth, which is positive when you look at the fundamentals. We're expecting fleet growth of around about 2.5% this year, and that's compared to about 4% last year. Plus, we do expect this slowdown in growth to continue moving forwards, with the majority of growth focused in the larger size segments. And in fact, if you look at the feeder fleet, we are actually, in our forecast, we are actually expecting the feeder fleet to contract in the short term. Now, this slowdown has helped, in fleet growth, has helped the balances, the fundamental balances this year. But again, as with bulk carriers, there are other factors that you have to take into consideration, and the fundamental slowdown in fleet growth is only part of the supply side story. A lot of the individual liners' success in navigating the crisis has been via supply side management, but here we're talking about things like blank sailings, idling tonnage, vessels out of service, scrubber retrofitting. With the impact of COVID-19 on demand easing recently, liner companies have started to unwind these measures. I think for container ships, the key question now is whether this positive story of above expectation post-lockdown boost to volumes and the supply side management can endure. And we're relatively positive at MSI. The fundamentals definitely suggest it can, and this is reflected in our forecasted time charter rates. Just very quick history, as we know, the onset of the lockdowns drove this correction in vessel earnings. Since then, vessel earnings for key sizes have risen sharply, particularly in the Panamax and above sector. We do expect the market rally for larger units will run out of steam in Q4, and we will see a fairly modest correction. Conversely, we do expect market balances for feeder vessels to see continual gradual improvements. And looking ahead further into the next several years, we'll see gradual improvement in annual average vessel earnings consistently across the board. So there is this nice upward trend. Now, while the time charter market improvement since Q3 2020 has been impressive, I think 2020 is likely to be remembered as the year of strong freight markets amidst all the turmoil. I mean, as we all know, Trans-Pacific rates in particular have held up very, very well, reporting in the news. And they've surged recently on the back of stronger demand fundamentals. Now, we do expect liner companies will achieve year-on-year gains in average freight rates when you look at it over the rest of 2020. But we do think it's possible that the scale of improvements will be a bit more muted, and there will be a greater reliance on healthier volumes to continue this recent run of profitability. Right, that brings us to the tanker market. Now, again, 2020 has been an extraordinary year for the tanker market. We've seen extreme volatility. Q2 saw some of the most extreme highs ever witnessed in the spot markets, followed by incredibly extreme correction. Now, the huge fluctuations in the tanker market this year, I'm not going to spend too much time on this, have been caused as a result of this schism, as we can see in this graph, the two graphs on this slide, between oil demand and production after the initial onset of the widespread lockdowns. Now, looking ahead, I think the key theme in oil markets over the next couple of years is really going to be the nature of the recovery in oil demand and the corresponding response in production. To give you a sense of where we are in terms of our current thinking for our base case, we do expect global oil demand will decline by about 8% this year, and production will drop about 5.7%. But this is going to be followed in 2021 by quite robust rebound in demand growth of about 6.3%, and production increase will be more modest at around about 2.5 to 3%. So, there will be this inherent market coming back into balance. But I mean, given these figures, it shouldn't really come as a surprise that our short-term outlook for seaborne trade in 2020 remains relatively negative. The fall in both oil production and demand has major negative ramifications for the seaborne crude trade. We expect it to fall around about 8% this year, with growth of just 2.6% next year, as production cuts. So those production cuts previously mentioned, they'll continue to exert pressure on volumes. For the seaborne products trade, there has been a recent fall in oil refining activity, and obviously this will have feed-through impact on products trade. Overall, we expect products trade to fall by probably around about 10% year on year in 2020. But unlike crude, we expect a much stronger rebound in 2021, and we'll see growth of around about 8%. So we won't hit sort of 2019 levels, but we will get relatively close. Now, when you're talking about the tanker market, a number of exogenous factors have come into play. And when you're looking at translating, trade volumes in terms of metric tons into the deadweight demand and demand for tankers, several factors do need to be taken into consideration. First and foremost is port delays. Now, Chinese ports have seen some of the most acute delays, but this applies globally, and it has had a drastic impact on the demand for tankers in 2020, helping boost it substantially. Now, offsetting this positive influence of port delays on demand in recent months has been the unwinding of floating storage. Now, the stories dominate the market for 3 or 4 months, and the extreme oil market imbalances, earlier in the year really did increase floating storage requirements, particularly in Q2, and that reduced the available fleet. However, the use of tankers as floating storage has reduced faster than expected, and we are starting to see a fresh wave of it at the moment, but nothing at the levels that we saw at the start of the year or in Q2. And at the start of August, we estimate that there was almost about 40 million deadweight of tanker tonnage in the Afra to the LCC crude size ranges that were operating as commercial floating storage. This was down about 11% month on month. Now, as tankers re-enter the active fleet over the remainder of the year and into next, the downside effects of COVID-19 shock are going to become even more apparent. We do expect the nadir to be reached in 2021 as sort of lower demand base grapples with the increased active supply of ships available. Looking at the average annual employment rate across the 10,000 deadweight plus tanker fleet, it's going to fall from around about 90.5% in full year 2020, quite drastically to about 87%. Obviously the market shock, this severe market shock, but relatively promisingly, we do believe it's going to be short-lived, and we are forecasting an improvement in employment rate from 2022 onwards. In terms of this improvement in the employment rate, demand growth will absolutely contribute to this. But the more important driver for the market recovery is going to be, again, on the supply side. Again, lower deliveries, significant increase in scrapping. And after 2020, we do expect the fleets to contract each year, not just in 2021 and 2022, but all the way through to 2024. So that will provide some relief to the demand, to the fundamental balance. Now, what this means in terms of achievable earnings, well, as I said earlier, 2020 has been characterized by the most volatile markets in history. We had those highs in April, which has given way to today's markets, which are very reminiscent of conditions witnessed back in 2018. Looking ahead, we do expect earnings continue falling into next year as demand remains subdued and the size of that available fleet increases. But we do then expect rates to recover from early 2022 onwards. Albeit these improvements will be modest, but they will be there, and this will largely be driven by the demand supply fundamentals and improvements on that front. Okay, very quickly on shipbuilding. All of the markets have been adversely been impacted by COVID-19 in one way, shape, or form. But I think it's fair to say some have borne the brunt of the impact more directly than others, and shipbuilding is arguably amongst the most severely impacted. If you look at fresh contracting, for example, it had already been quite relatively muted in 2019, given uncertainty over IMO 2020, new building technology, fueling choices. And what COVID-19 has done is actually just amplified these concerns. And as a result, contracting this year has been very, very low. We're probably looking in the first half of the year of just around about 5 million CGT. And the pain has been evenly spread across the different markets. But if you exclude passenger ships, volumes are actually, double 2016 levels, which, is relatively positive. Another positive note is that we do expect 2020 to be the nadir of the current contracting cycle. And as you can see in the graph, volumes will pick up next year, and then really as we go into 2022, 2023, and then through to the middle of the decade, we will start to see healthy levels coming back into the shipyards. Now, in terms of what this means for prices, they will continue. New building prices will continue to decline in the short term. This is a trend that began before the pandemic, but promisingly, the scale of the decline is been relatively muted so far. Prices aren't really that much lower today due to two factors. So the fact that they aren't lower is due to two factors. The first is this program of ongoing reduction in shipbuilding capacity that we've seen, for the last 5-6 years, not longer. The second is, of course, the fall in shipyard costs, and these have, on average, declined about 8% since their peak in 2018. Again, we do expect next year to be the nadir in terms of global shipbuilding prices. We will see them bottom out next year, and then they will recover thereafter over the course of the next decade as contracting levels improve. And with that, we really actually reached the crux of the presentation. So everything that we've covered so far, our market outlooks for bulkers, tankers, containers, our position on the shipbuilding industry, that's all based or rooted in MSI's Q3 2020 base case, which, as I said earlier, was published a couple of weeks ago. Our base case is based on the assumption that we're going to see a gradual unwinding of the pandemic over the course of this year and into next. But the problem with COVID-19, I think everybody in the audience will agree, one of the facts that it's really driven home is just the level of uncertainty it brings to everything, like how things can change quickly, unexpectedly, in all aspects of our lives, but particularly, also in terms of the shipping markets. Now, in order to stay ahead of the curve, the analysts here at MSI use proprietary forecasting models to do scenario-based analysis for a range of possible outcomes to stress test our base case. Now, this model is available to clients through our online platform, MSI Horizon. Essentially, clients can log on to these models. They come preloaded with our base case assumptions, and then users can change all the assumptions as they see fit. The assumptions you can change range from macroeconomic indicators to trade volumes to individual commodities, supply side responses, fleet efficiencies. Basically, you change the assumptions, you press a button, and the system shows you how it's going to impact the market of your choice in demand, supply, in terms of market balances as well. So what we did was we actually used MSI for the purposes of this presentation. We used Horizon to ask the question, what would happen if there was a significant second wave of COVID-19 outbreaks in key regions over the next 6 months? And then there would be a more prolonged struggle to eliminate the virus over 2021. Now, from this fundamental question, we developed a set of assumptions for this low case scenario, a lot of which are detailed on this slide. We plugged them into MSI Horizon and applied them across all the different shipping markets. The next slide gives you the results for the dry market, just by way of example. Now, under this low case scenario, seaborne trade in dry bulk commodities will fall 2% year on year in 2020, compared to around 1% in our base case. The impact on the rate of recovery in 2021, however, is far more significant. Compared to demand growth of over 5% in our base case, it's actually around about 2.5% to 3% in the low case. The biggest impacts, iron ore, coal, and essentially this prolonged weaker vessel demand would have an impact on both earnings and asset values in the sector, as these graphs demonstrate. Positively, however, they would still remain above the lows that we saw in 2016, again because of the gene factors that I mentioned earlier. Now, the next one, we have the tanker markets. Unsurprisingly, under the low case scenario, they're also going to struggle, but we're not eternal pessimists here at MSI. We do recognize, obviously, that there's the case for upside potential, and for the tanker market particularly, we've seen this volatility over the last couple of years. Now, in this scenario that I've put on the screen, there's two assumptions. The first is that there's this bridge in the demand supply gap in 2021, and that's probably could be achieved by periods of demand excess, which would drive volatility. There's also the potential for strategic store builds, particularly in Asia. And these combined could increase employment rates, resulting in, as the graph shows, very substantial earnings improvements. Finally, very quickly before I wrap up, given all this uncertainty, I thought I would end with MSI's traditional marine money slide. Where would you invest your money? So what I've done here is I've just put up a slide that looks at a hypothetical 5-year investment, namely the IRRs of various investment by ship type if you were to buy a 5-year-old ship now in Q3 with the view to sell it towards the end of 2025. A few trends are clear. First, our outlook on container ships is strongest. Second, there is a definite weighting to the smaller ship sizes. And finally, even though IRRs are more modest under the low case, they're not drastically so. And on that positive note, I'll bring the presentation to the end. Thank you very much.
Thank you very much, David, for that, for providing us with that good context. If anyone from the audience would like to get in touch with MSI to discuss anything that was presented on today's presentation, you can find the email address on this slide.